Now, before I start the discussion with respect to concept of savings, investment and capital formation, please understand this is not a concept within microeconomics. Do not try to search for savings, investment, etc. in different books under microeconomics. You will not get it. Generally, this is discussed as a part of macros, right? Macroeconomics to be more precise. But because we have discussed, right, demand, investment in the market, etc., I just want to connect the concept of savings and investment in the beginning itself, right? So that in the future videos or in the subsequent videos, when I say investment is expected to increase, savings is going to add to capital formation, etc., you should not be confused as to what I'm actually referring to. So because we are discussing the basic concepts here, I just want you to understand the idea of a savings as well as investment here itself. Now, generally when you discuss the idea of a savings and investment, these are certain very important points. Let's imagine here is a person, okay? Here is a person XYZ. Follow the sequence, then we'll try to understand what is the meaning of each one of the terminologies. This particular person XYZ, imagine he has earned 100 rupees. Now, rather than using the term 100 rupees or earnings, in the books they'll use the term disposable income. Okay, they'll simply use the term disposable income. Now, what do you mean by the term disposable income here? Disposable income basically refers to that part of the income which is available to, let's say, a person after taking care of all the deductions that are required. For example, he has to pay taxes to the government. So out of 100 rupees, if he makes a payment of tax to the government, whatever is left out can be referred as a disposable income. Now, in this particular context, let's assume his disposable income is 100 rupees. Okay. He has paid whatever liabilities are there towards the government. He is left with a disposable income of 100 rupees. Now, with this particular 100 rupees, let's say out of this, he will use a 40 rupees for immediate consumption. Okay, he will use a 40 rupees for immediate consumption. What do you mean by immediate consumption? He will use 40 rupees for food, travel, clothing, etc. So if you take out this particular 40 rupees, which is an expenditure part here, what you are left out with 60 rupees, and this particular 60 rupees is savings. This particular 60 rupees is savings. First point. Second very important point, the same what we have discussed right now can be given in the form of a formula, and that particular formula is the savings is equal to the income minus expenditure. And when I'm saying income here, I'm referring to disposable income. Okay, so savings is equal to the income minus expenditure. That is the second very important point. Third, go back to the original discussion or the starting point of discussion in case of the economics. I've stated that in any economy, such as Indian economy, there are three very important participants. One, you have household. Second, you have government. And the third, you have firms or companies. Is it okay? I'll use the short form here. Household, the government, as well as the companies. So all the three will have certain amount of savings. And why these particular savings are important? Savings get translated to capital formation. Is it okay? Savings are translated to capital formation in the economy. Now, what do you mean by capital formation here? Let's assume there is an economy, and in this particular economy, there are 4 companies. Okay, 4 manufacturers are there, and all the 4 manufacturers put together have 10 machines. Is it okay? They have 10 machines. Now, if in addition to these particular 10 machines, if they purchase 2 more machines, total number of machines will be how much? 12. And these particular machines are basically nothing but, okay, these are nothing but assets in an economy. What do you mean by asset? Asset refers to anything which will have certain value. We will store the value or wealth in certain form, and this is referred to as an asset. Is it okay? Anything that is a wealth or the storage of a wealth is referred to as an asset. So machine can be used to produce goods, can be used to manufacture goods, goods can be sold in the market, value can be obtained, right? So machines are assets, right? For example, manufacturing facilities are assets, roads are assets, bridges are assets. So anything, right, which will store the wealth like this can be referred to as an asset. I'm just taking a simple example here. In an economy, I'm assuming there are 4 companies, 4 manufacturers who earlier had 10 machines, which are nothing but assets. But in this year, they have purchased 2 more assets or 2 more machines. That becomes addition to the existing assets. So this particular addition of 2 machines is nothing but capital formation. Is it okay? This is nothing but capital formation. So in essence, whenever investments that are done in an economy get translated, get converted into creation of an asset, to the existing assets, we will add a certain assets in a particular year, and that is nothing but the capital formation. Okay, let me take another example. Imagine the total value of the assets in Indian economy are worth 1 lakh crore rupees. Okay, worth 1 lakh crore rupees. Now to the existing value of this particular assets of 1 lakh crore rupees, in this year, what if I've created assets, I've added assets worth 50,000 crore rupees? Is it okay? Right? What kind of assets? National highways, tunnels, bridges, machines, goods, etc. All of these are assets. So whenever I've added this particular 50,000 crore worth of assets, total value of the assets in the economy will increase. But when I say capital formation, it refers to these assets which are getting added to the existing pool of the assets. Existing assets were worth 1 lakh crore rupees. To this particular 1 lakh crore rupees, I've added assets worth 50,000 crore rupees. This 50,000 crore rupees is essentially the idea of a capital formation. So understand this, savings will add to capital formation. How? These particular savings, let's say 60 rupees, this person XYZ will keep it in a bank, either in a fixed deposit, savings bank deposit. Don't worry, he has kept it in a bank. Now what will the bank do? Bank will issue this particular 60 rupees in the form of loan. So there is a manufacturer who will take this particular 60 rupees loan and purchase a machine from the market. Now please do not ask me, sir, in 60 rupees which machine can you purchase? That is not important here. But the argument here is the savings will become investments in the market. Is it okay? So the manufacturer is investing this particular 60 rupees to purchase a machine which is nothing but an asset. So when he purchases a machine, invests in the market, this investment will add to the creation of an asset, and this is nothing but leading to capital formation in the market. Is it okay? It is leading to capital formation in the market. Now the investment in the market can be done by the companies. Yes. Can be done by households. Yes, like this. Can be done by the government? Yes. So the total investment that is done in an economy could be coming from the households, could be coming from the government, could be coming from the companies or corporates or firms. But within these particular corporates, again you will have 2 divisions. One which is the investment which is coming from the domestic sources. Imagine a company such as Tata, Infosys, etc., which are present in India, investing in India. That is the investment which is coming from the domestic source itself. In addition to this, can we have foreign investment in India? Yes, there is a source called as foreign direct investment, wherein a foreign company comes into India, will invest in India. For example, Accenture company will come into India, develop offices or invest and develop, let's say, a company, set up a company. Volkswagen company, car manufacturing company, has come into India, invested and has set up a manufacturing facility, right? Apple has set up a manufacturing facility in India. So don't you think the foreign companies will come into India, invest in India, which will add to the capital formation in the domestic market? So these are certain very, very important points. So higher the savings, it will lead to higher investment, and higher investment is associated with capital formation. And generally the capital formation, right, is represented in the form of GCF, gross capital formation. And the formula for gross capital formation is what is the total amount of investment done in a particular economy divided by the value of a GDP into 100. Okay, the amount of investment done, right, in an economy divided by the value of GDP. GDP stands for market value of goods and services in a particular country, right, into 100. Let's take a simple example. Imagine in India, the total value of investment done is to the tune of 40,000 crore rupees. Okay, and the value of a GDP is, let's say, 1 lakh crore rupees. Then in simple terms, the gross capital formation will be at 40% for Indian economy. Right? So generally there is no fixed number. There is no standard number for gross capital formation. The argument here is whenever the gross capital formation is somewhere in the range of 40%, that number is preferable. Now what has happened in case of India? What is the situation in case of India? First very important point. Of the three participants or economic agents, that is the government, the private sector, that is the firms or companies, as well as the households. Majority of the savings actually comes from the households. Is it okay? Remember this. There are three entities or three agents. All the three put together will have certain domestic savings. But out of this, majority of it comes from the households themselves. Right? Generally to the extent of around 60 to 70% of the savings actually comes from the households. Generally these particular numbers of savings, investment, capital formation, etc. are given as a percentage of GDP. Is it okay? These are given as a percentage of GDP. And when I say gross capital formation is 40%, it simply means 40% of GDP. So understand the logic here. Whatever is the capital formation in case of Indian economy, out of the savings, majority of the savings to the extent of 60 to 70% is coming from households itself. And that is the precise reason why the savings in the households is very, very important. If the household savings are coming down, that will have an impact on the investment scenario in India. If the household savings starts increasing, it is expected to lead to higher capital formation in India. That is the importance of household savings. First point. Second very important point. In case of the savings, again there are two types. One is financial savings, which is very, very important. And the second one is physical savings. Okay, one is financial savings and the second one is physical savings. Now, what is the importance of both of them? Financial savings are generally associated with investments in the market, creation of assets in the market. And that is the precise reason financial savings are very, very important. Whereas physical savings, for example, investment in real estate assets, investment in gold, these are not generally considered to be favoring capital formation in an economy. So out of these two savings, you need to have more and more financial savings compared to physical savings, right? So whenever a household's savings, most of them become physical savings, that will add to stress or concern for the government of India. So you need to ensure that from the household savings, majority of it are in the financial savings rather than being in the physical savings. Done. That is second very important point here. Now the third very important point, the gross capital formation generally is divided into two parts. Okay, the gross capital formation is generally divided into two parts. One, assets such as infrastructure are referred to as a gross fixed capital formation, and assets such as stocks or inventories are referred to as a stock. And please understand, both of them are assets. No doubt, both of them are assets. Right? For example, let's assume here is a manufacturer B. He has taken, let's say, a loan from the market. Using this particular loan, can he purchase a machine from the market? Yes. Using this, can he construct a new manufacturing facility? Yes. Using this, can he manufacture goods and services in the market? Yes. And using all of them, right? All of them are nothing but the assets itself. Right? Some are mobile assets, some are immobile assets. But the argument here is some of the assets related to infrastructure, related to manufacturing facility, roads, national highways, ports, etc. These are clubbed under the concept of gross fixed capital formation. And the other part of the GCF is basically stocks. Is it okay? For example, the raw materials which are held in the manufacturing segment, the inventories which are stored, or the change in the inventories which are stored, right, in the warehousing, etc. Right? So the sum total of gross fixed capital formation as well as the stocks will give you total gross capital formation. So this is a basic discussion with respect to the savings, investment, as well as capital formation. Now, what has been the situation in case of India? Post 2000, especially post 2003 and 4, the gross capital formation or GFCF, which is the most important component within the GCF, has kept on increasing. As a percentage of GDP, at one point of time, it hit around 35 to 36% of GDP, the highest in the last 2 decades. After that, because of the crisis in the global market, the gross capital formation as well as GSCF started declining in case of India. But in the recent times, again it has started picking up. But generally, the gross capital formation lies somewhere in the range of 30%, which is considered to be suboptimal for Indian economy. You need to have much higher gross capital formation to the level of around 40% of GDP. So these are some of the very important points with respect to concept of gross capital formation. And that is the end of the discussion with respect to the introduction of economics, wherein we have discussed certain very important concepts within the microeconomics. And then we have discussed the concept of a savings, investment, as well as capital formation. Okay, thank you.